Hello and welcome to our 2020 market preview. In the following video, we will offer a high-level summary on an asset class by asset class basis of what to expect in the coming year. This is an abbreviated version of the newsletters which were recently posted to our website, which are detailed articles outlining our expectations, trends, and themes for each asset class in 2020. I'm Greg Leonberger, the Director of Research here at Marquette, and joining me today are our lead asset class analysts for each of the asset classes we will cover on this session. Ben Moore will talk about fixed income, Samantha Grant will cover U.S. equities, David Hernandez will discuss non-U.S. equities, Joe McGuane will cover hedge funds, Jeremy Zirin will cover real estate and infrastructure, and last but certainly not least, Derek Schmidt will cover private equity. We will follow the traditional agenda of these sessions. We will start by talking about the U.S. economy, since that is a natural backdrop for most of our clients and investors. We'll then move to traditional investments of fixed income, U.S. equity, and non-U.S. equity. Then finally, finish with alternative investments consisting of hedge funds, private equity, real estate, and infrastructure. Let's start by talking about the U.S. economy. On the whole, we think the U.S. economy is in a good place. We've used the term Goldilocks economy more than once to describe the state of the U.S. economy. GDP growth is expected to be in the 2 to 3% range again for the fourth quarter. The most recent forecast is 2.3%. The December unemployment rate remained unchanged at 3.5%, with 145,000 new jobs created. And inflation, as indicated by the third arrow here, remains under control around 2%. The impeachment proceedings are not expected to have a material impact on the economy or financial markets. And in some good news for investors, the Phase 1 trade deal between the U.S. and China was signed into effect on January 15, 2020. Of course, like any year, there are risks that we will be monitoring and watching carefully on behalf of our investors and the potential impact on capital markets. We will look to see if interest rate policies and accommodative policies on behalf of central banks continue into 2020. We are always watching liquidity, particularly in below investment grade pockets of the market. The U.S. election, potential policy impacts of that could also have an impact on market returns and potentially market volatility. The U.S.-China trade dispute, despite Phase 1 trade deal being signed into effect on January 15th, still needs to be ironed out and the many other issues which need to be resolved between the United States and China. Finally, the last 2 points. There are always geopolitical risks, and we will also be watching to see if consumers continue in their spending ways to support the U.S. economy.
I'm Ben Moore, Marquette's Director of Fixed Income, and I'll be sharing with you our fixed income outlook. As we head into the 2020s, one of the questions top of mind among investors is, with the equity markets at all-time highs, bond spreads at all-time tights, and a yield curve that's just undergone an inversion between the 2-year and the 10-year, will it really be different this time? Meaning, could our market and economy avoid a Great Recession like what followed 2008, or worse, a Great Depression like what followed the 1920s? The fact that we are in an election year will make this question especially difficult to answer, but as investors, we need to stay vigilant in tracking and interpreting the key data. We'll do a quick review of the fourth quarter of 2019 here and examine the forward-looking data in the following slides. In the fourth quarter, the Fed cut a third and last time since the Great Recession so far, and the 10-year rebounded from its 1.47% bottom to 1.92% at year-end, with a steepening curve as the U.S.-China Phase 1 trade deal was announced. The Fed rate cuts in 2019 reduced yields on the short end of the yield curve, while the trade war drove both foreign and domestic buying on the long end. The end result was a duration-driven tailwind for all fixed income asset classes, with the full brunt of the tax cuts aiding credit. Bonds generally did very well. The AG returned 8.7% in 2019 as bank loans returned 8.2%, high yield returned 14.3%, and emerging markets debt returned 15%. Core bonds, while not showing much value due to their spreads being near all-time tights, still provide moderate yield and strong protection in market downturns due to their duration. With the tailwind from easing trade tensions, the yield curve has steepened now to being almost entirely upward sloping following 2's/10's inversion in the third quarter of 2019. The next Fed rate cut with an over 50% probability, as deemed by the Fed Funds futures market, has been pushed out to the November 2020 FOMC meeting as the Fed reduces their accommodative stance. However, the aging demographic persists globally, which may potentially pressure rates down in the long term, barring any technological revolution that boosts productivity and raises rates. The outcome of the U.S. presidential election will inevitably have some effect on interest rates. Our Trumponomics second term, Bidenomics, Warrenomics, and Bloombergonomics preliminary projections show a slight boost to GDP hand in hand with growth in the U.S. deficit in all cases generally, with deficit growth the highest in the Trumponomics second term scenario. This slight GDP boost in all cases may stave off further rate declines a bit, at least for the short term. In terms of bond valuations, tight spreads exist generally across the board for fixed income. They are at all-time tights for core bonds, investment-grade corporates, securitized bonds, and non-U.S. developed markets debt, as these sectors have been where investors have moved for duration and for lower risk fixed income as a hedge against their risk-taking in equities in 2019. In general, we believe that if the U.S.-China trade deal ultimately materializes, rates would be expected to rise and in turn be a headwind for bond returns. On the other hand, if a trade deal is unsuccessful, rates would be expected to decline, thereby potentially boosting bond returns. In all cases, we continue to advocate a healthy allocation to core bonds as the duration continues to provide strong principal protection in market corrections. Bank loan spreads are now tighter than long-term averages, while high-yield spreads are now approaching all-time tights. Additionally, we are seeing that dispersion between the lowest quality credits and higher quality credits are expected to continue as lower quality issuers struggle to refinance. Active management in all fixed income asset classes is now more important than ever. New sub-investment grade bond issuances' use of proceeds, leverage, and coverage reveal further moderate to cautious corporate fundamentals. It is still somewhat a Goldilocks market, not too hot, not too cold, but it may be time to take some risk off the table given the tight spreads and these moderate to cautious corporate fundamentals. We see that refinancings as a use of proceeds for both high yield and bank loan issuance is high, a positive fundamental, as sub-investment grade issuers are able to tap both the high yield and bank loan markets to keep refinancing their debt, and they are choosing to refinance over certain other uses of proceeds. We look at bank loans and high yield because they are first in line to show any weakness before investment grade bonds. Other strong points are that high yield issuance use of proceeds towards acquisitions and LBOs are low, which is a positive as high yield issuers at least are not taking too much risk. However, a lot of high yield issuance for acquisitions and LBOs has been substituted for bank loan issuance towards acquisitions and LBOs, which is why we see that red 54% today. The good news here is that it subsided a bit in 2019 versus the 65% high in 2015 and 63% high in 2018. The CEOs and CFOs of sub-investment grade companies do not appear to be taking as much risk as they did in 2007. Another good sign is that CCC high yield issuance and second lien bank loan issuance both remain very low compared to their levels in 2007, further reinforcing the notion that risk-taking by sub-investment grade issuers remains low. One caveat here is the growing level of liberties taken by issuers in accounting for their EBITDA, a proxy for cash flow, as some are aggressively using add-backs to inflate their EBITDAs. An example of an add-back is a non-recurring restructuring expense, and an unjustified add-back may be a recurring expense that issuers account for as non-recurring and therefore adding back to their EBITDA to inflate their EBITDA. That might be a factor behind at least why these numbers don't look so frothy, at least at face value. Having a strong EBITDA on paper allows issuers to issue more seemingly higher quality debt and less CCC or second lien debt. EMD spreads are now near all-time tights. Spreads have tightened following pro-business Macri's loss to populist Fernandez in the October 2019 Argentine presidential election, as it was largely priced in beforehand. But thoughts now turn to potential Argentine debt default as a major headline and sentiment risk. That said, EMD fundamentals, current accounts, growth, and leverage remain favorable, with lower emerging markets leverage versus developed markets leverage. The municipal yield curve bull steepened during the fourth quarter as the short end declined and long end remained flat, while treasuries bear steepened as long treasury yields rose, reducing the muni treasury ratio. But the muni treasury ratio is still above 0.8. Thus still showing value for municipal bonds over treasuries for taxable investors. In investment-grade muni portfolios, pre-refunded bonds continue to provide the best high-quality value. Highly rated GO bonds, essential service revenue bonds such as water, sewer, and electric, and private university bonds will also be important strategic municipal bond subsectors for 2020. Furthermore, net negative issuance is still expected for 2020, a tailwind for the asset class. Together, the metrics we just covered paint a moderate to cautious picture for fixed income fundamentals, probably not at the concerning levels of 2007, but more like 2005 or 2006 levels and gradually approaching 2007 levels. There is some level of deterioration, but we do not expect a recession to be imminent. The trade agreement and U.S. election may boost or hinder growth in the short term, so these are wild cards that we will keep track of closely. Over the longer term, interest rates are expected to continue to grind lower due to the global aging demographic phenomenon, barring any technological revolution that boosts productivity and raises rates. For 2020 and beyond, we recommend maintaining a healthy allocation to core bonds for their duration protection and maintaining strategic allocations, but trimming risk around the edges given the tight spreads and moderate to cautious fundamentals. With core bonds, the yield curve is now almost entirely upward sloping. There's been a downtick in consumer bankruptcies and student loan delinquencies, and duration continues to provide principal protection. With bank loans and high yield, spreads are tight, and the fundamentals are at moderate to cautious levels. With EMD, spreads are near all-time tights, but fundamentals are still strong. Lastly, with munis, the asset class is still attractive.
I'm Samantha Grant, and I'll be covering U.S. equities. The equity market came roaring back at the start of 2019 after hitting bear market territory in December 2018. Specifically, 2019 holds records like the best January since 1987 and the best first quarter since 1998. As the market reached higher and higher peaks, the recovery was not entirely smooth. Concerns around slowing economic growth, falling earnings growth, and a global manufacturing recession began to take hold early in the year. However, the Fed's late-cycle interest rate cuts helped to provide a more supportive backdrop. By the fourth quarter, a reduction in tariff tensions and the promise of a Phase 1 trade deal with China all but cemented an extraordinary year. The S&P 500 posted 22 new closing highs during the fourth quarter alone. The result was the fourth highest returning calendar year over the past 30 years. For the year, all U.S. equity style boxes posted double-digit returns. Large cap growth was the best performing area of the equity market, up over 36%, while small cap value, up a meaningful 22%, was the worst performing area. Declining earnings hit small cap stocks particularly hard as they are generally more economically sensitive. From a factor perspective, large cap stocks outperformed small cap stocks and growth outperformed value. But 2019 was not a flawless year. Trade tensions were accountable for the two negatively monthly returns in the S&P 500. In May, tensions escalated, which weighed on cyclical stocks, and in August, tensions flared again, which resulted in the Fed lowering rates, a yield curve inversion, and the devaluation of China's currency. Although the Phase 1 trade deal is officially inked, we still expect to see sporadic bouts of volatility in 2020. While all sectors yielded positive returns for 2019, volatility is always a risk to companies doing the best and the worst. Sometimes it's positive, like in January's market spike, and sometimes it's negative, like an August decline. Technology was at one extreme, posting a 50% return, while energy was at the other, generating an 11% return. Mega-cap stocks like Apple and Microsoft were the largest contributors to the market return for the year. These high-flying stocks can also be susceptible to risk-off environments, as well as changes in factor leadership. When markets turned to favor value in the fall, laggards for the year in healthcare and energy posted solid returns, while FANG stocks sold off. However, growth animal spirits returned in December to boost technology again. So where do we stand now? The S&P 500 trades at an above-average forward PE ratio of 19 times forward earnings. Mega-cap, large-cap, and mid-cap indices all trade near all-time highs. However, small and micro-cap indices have yet to recover from their prior 2018 highs. While there is a valuation argument to be made for smaller cap stocks, these stocks are more dependent on the economic environment, earnings, and margins. With economic growth expected to remain low, it's possible that small cap stocks can continue to lag their larger cap peers. Key questions heading into 2020 include by just how much a lower interest rate environment, trade war de-escalation, and an improving earnings picture can support or extend current valuations. Next, I'll turn it over to my colleague Rob Brittenbach to finish the U.S. equity outlook.
While U.S. equity valuation metrics are high in absolute terms, at least according to the Fed model, stocks are not overvalued. This methodology compares 10-year Treasury yields to the S&P 500's earnings yield. The Fed model is not without flaw or criticism, but according to this measure, stocks have been undervalued relative to bonds since 2002. With short-term rates globally at historically low levels and expected to remain so in the near term, it is possible that we see continued risk appetite or yield-seeking behavior among investors as they are pushed further out along the risk spectrum. The term "there is no alternative," or TINA for short, has been used to describe investing in equities when there are few other good alternatives. With this in mind, it is possible that investor tolerance for above-average valuations can continue. In 2019, earnings growth steadily fell while prices rose, so virtually all return came from multiple expansion. For the full year, S&P 500 earnings grew by just 0.3%. For 2020, analysts are projecting earnings to grow by 4.6% in the first quarter and 9.4% for the year. Hope for an improving earnings and economic picture helped to fuel 2019's year-end rally. Given this, we believe a greater emphasis will be placed on earnings in 2020 to support current valuations. Earnings projections are often revised downward throughout the year, so the actual value is likely to be lower than 9.4%. Nevertheless, an improved earnings picture relative to 2019 would be a positive for equities. After a year of such strong gains, it is comforting to know that equity returns can still be positive the following year. Looking at S&P 500 returns dating back to 1928, the index produced an average return of positive 7.8% in the year following a 25% plus return. Perhaps more importantly, the following year's return was positive 74% of the time. It remains to be seen just what 2020 has in store for equity markets, but at the very least, it is assuring to know that probability is on our side. Overall, there are less recessionary concerns today than at the start of 2019. But while uncertainty is reduced, it is unlikely to go away. 2020 is expected to feature continued political and economic uncertainty. The low interest rate environment is expected to continue in the near term and may even help further extend this market cycle. As we think about return expectations for 2020, it is important to recognize that the source of 2019's return came largely from multiple expansion. Valuations today are noticeably higher than when we began 2019, so another year of multiple expansion seems unlikely. We anticipate returns in 2020 to be positive and more in line with earnings growth. With 9.4% earnings growth projected for 2020, single-digit positive returns appear to be a realistic estimate.
I am David Hernandez, and I will be covering the non-U.S. equities section. After a weak 2018 performance where most broad benchmarks produced double-digit losses, non-U.S. equities snapped back with a double-digit gain in 2019. Developed markets, for example, returned 22%, and emerging markets returned 18.4%. So the question is, why did we have such strong performance in 2019? Well, it wasn't because of the global economy, and it wasn't because of earnings growth. Both economic data and earnings disappointed for much of 2019. Additionally, global uncertainty remained elevated, with issues like the Brexit and U.S.-China trade relations hanging over the market throughout much of the year. But we did start off the year with relatively low valuations thanks to a 4Q 2018 sell-off, and central banks throughout the world stepped up and took accommodative actions. So with investors anticipating a rebound in economic and earnings momentum, they bid up equities, leading to strong returns in 2019. Now, in the coming slides, we will discuss what we think that means for 2020, along with some of the risk and opportunities that we see in the year ahead. Firstly, global uncertainty remains elevated. Though there has been progress, the Brexit and U.S.-China trade relations are still unresolved, and we expect these events to continue to impact markets in 2020. In the UK, thanks to the December election, the Conservatives now have a majority, so perhaps PM Boris Johnson can push the Brexit past the finish line later this year. The UK and EU will be in a transition period at least through December 31st, 2020, and they still need to reach an exit deal to avoid a hard Brexit. The US and China signed the Phase 1 agreement on January 15th on Wednesday, putting a halt to the trade war. China committed to boosting imports and better protection for intellectual property rights. The US pulled back on tariffs and also removed the currency manipulator tag it placed on China last year. Like the Brexit, there's still more work to be done, and we're likely to see these two events continue to influence equity markets in 2020. In general, investors and businesses do not like uncertainty. Companies that ensure future trade relationships between the EU and UK or China and the US are likely to cut their future investment plans. Cuts in business spending typically lead to a drop in economic activity. The Manufacturers Purchasing Managers Index illustrates this point well. Over the last 2 years, the global indicator fell from 54.4 in December 2017 to 49.3 in July 2019. This level signaled a contraction in economic activity. However, we did end the year on a positive note with PMI rebounding in the last quarter. Additionally, the services sector have held up much better thanks to improving unemployment rates, positive wage growth, and a generally positive outlook from the consumer. But the consumer could not make up for the drop in manufacturing, and as a result, we've seen global GDP forecasts come down. In 2017, we were in an environment with strong economic momentum, and we saw GDP forecasts increase through the year, moving from 3.2% to 3.6%. Now, with economic momentum losing steam, forecasts have fallen from 3.7% in 2018 to 3% in 2019. This slowdown has not gone unnoticed. Central banks throughout the world took accommodative actions in response to the slowed economic growth. The developed markets central bank policy rate, which is an aggregate rate for all of developed markets, this rate dropped from 1.96% in 2018 to 1.39% in 2019. Emerging countries jumped in on the party. You had countries like China, Brazil, Indonesia, Mexico, Russia, Turkey, and the Philippines all employ interest rate cuts in 2019. This central bank activity boosted investor optimism, leading to strong returns in anticipation of better economic and earnings data in 2020. While central bank support is a current positive for equity markets, a negative is earnings in 2019, as global earnings growth was actually negative for the year. Looking forward, 2020 earnings growth estimates range from 8 to 14%. In a typical year, estimates are revised downward as analysts usually begin with a more optimistic view. In fact, at this time last year, 2019 estimates ranged between 5 and 8%. Will the 2020 expectations hold up? We think the answer to this question will help determine the performance from non-U.S. equities. If they hold up, we think that we can see returns between 8 and 16%. If we have a repeat of 2019 with dramatic downward earnings revisions, we think that negative returns are a strong possibility. Compared to this time last year, we think there is considerably less wiggle room for equity markets. Thanks to a 4Q 2018 sell-off, valuations were much lower at the start of 2019. We have since seen price-to-earnings multiples increase by roughly 30%. So we think a lot of the upside is currently priced into equity markets, and any downside surprises will lead to tough returns. Simply put, there's less room for error in 2020 compared to 2019. Now, there are reasons to be optimistic on non-U.S. equity markets. We've seen progress on U.S.-China trade relations, we've seen progress on the Brexit, and central banks throughout the globe remain supportive. Additionally, we've seen signs of a bottom in economic data, and we hope that that will carry forward into 2020. But valuations and expectations are high, so we think there's less room for error, and this is why we take a cautious view on non-U.S. equities for 2020.
Hello, I'm Joe McGuane, and I will be covering hedge funds today. So let's get started. Hedge funds advanced in December to conclude 2019 as the strongest performance since 2009, when markets were recovering from the global financial crisis. Equity hedge was the top performing strategy, as optimism over trade and the U.S. economy drove equities to lead broad-based global gains. Technology, communication services, and financials led the way in 2019. Convertible ARB strategies had a strong year, as an uptick in single-name volatility, coupled with a robust new issue calendar, the highest in over a decade, provided macro tailwinds. The technology sector was the main driver of new issuance in 2019. Merger arbitrage had a positive year, as large deals were announced throughout the year, with companies taking advantage of cheap financing to acquire growth late in the cycle as they prepare themselves for an overall slowdown in the economy. Companies across all sectors and industries continue to face technological disruptions, which has inspired cross-sector deal activity. Macro hedge funds finished in positive territory as managers were able to generate performance on yield curve trades in the UK and Japanese rates, along with long positioning in US and European equities. Losses among managers throughout the year largely stem from emerging markets and some European markets. As we enter an election year, Marquette recommends focusing on managers who take a hedged approach to investing, as they will be best positioned to see an uptick in volatility across global markets. The following chart breaks down the selection effect observed in equity hedge managers over the past 9 years. 2019 was one of the top years for stock picking in the past decade, as the selection effect has been the biggest contributor to returns this year, rebounding from a lackluster 2018. The only other year that has been stronger since 2010 was 2012. Style factors were positive contributors in January and February of 2019. However, factor volatility and returns have been more mixed towards the end of the year given the drawdown in September and the subsequent recovery. We expect stock picking to be a key to a successful 2020 as market volatility will likely rise ahead of the U.S. election. This chart shows the net leverage across long-short managers was at the low end in 2019. This was one of the lowest yearly levels Morgan Stanley Prime Brokerage has seen. Given this, managers were not able to capture as much of the market gains as they would have with higher nets. In other years of strong hedge fund performance, funds were running with an average net leverage much higher, notably in 2013. We expect managers to remain defensive as we enter 2020 given the many unknowns in the market. The following chart looks at the implied versus realized volatility for options pricing on an annual basis. Implied finished above realized volatility for 2019 as option-based strategies finished the year in positive territory. Given a strong equity market, these type of strategies were not able to keep up with the S&P 500, with most only capturing 50% of the upside. In 2020, we expect to see an increase in volatility, which can be positive for options selling funds going forward. This chart shows the performance of Goldman's portfolio of favorite hedge fund picks, which draws from 800 hedge funds. The Goldman Sachs Hedge Fund VIP Index is heavily weighted towards infotech, communication services, healthcare, and consumer discretionary. This basket of commonly held hedge fund holdings held up well against the S&P 500 after a disappointing 2018. Hedge fund holdings sold off in the third quarter related to the momentum versus value factor move, but recovered in the final month of 2019. We will be following this index closely in 2020 to see if managers make any wholesale changes to their commonly held positions. And finally, as we enter an election year, we expect market volatility as more clarity comes to the forefront on who will be the eventual Democratic nominee to face President Trump in the election. Given the uncertainty, Marquette recommends focusing on managers who take a hedged approach to investing. When it comes to equity hedge managers, we tend to favor those focused on a specific or a limited number of sectors. Those managers tend to be experts in their sectors and best able to pick winners and losers depending on market movements and election dynamics. When we look to the credit markets in 2020, we see a more benign environment as corporate credit spreads remain near all-time tights despite decreasing market liquidity, U.S. political elections, Brexit, and trade tensions. Given all of this, taking a long-short approach to the credit markets is recommended as we expect more volatility and a lessening of liquidity in the space. In merger arbitrage, we expect this strategy to see an increase in corporate activity ahead of the U.S. election as rates still remain attractive to finance such deals. This could change if disappointing news comes out regarding the U.S. and China trade, or a surprise were to pop up ahead of the U.S. election. Areas of opportunity for macro managers center around volatility associated with central bank actions, which are likely to create opportunities around curve trading and cross-country relative value trades. With all the uncertainty expected in 2020, manager selection remains paramount when structuring a hedge fund portfolio. Marquette recommends focusing on managers that have a track record of generating alpha over an extended period, both on the long and short side. Experience will be critical as managers will likely need to dynamically adjust their portfolio as market conditions change rapidly. Marquette continues to believe hedge funds are a valuable part of clients' portfolios given the diversification they provide.
I'm Jeremy Zarian, and I'm going to review the real estate section. Real estate has thrived since the global financial crisis as a result of economic growth, falling interest rates, and low inflation. While we don't expect these market conditions to go away completely, the macro environment is changing. What has worked in the past is unlikely to work going forward in the face of anticipated future slowing global economic growth, trade war uncertainty, political polarization, heightened asset values, and disruptive technology. However, it is not all doom and gloom for the asset class. Potential tailwinds include an ongoing low interest rate environment, stable fundamentals, and favorable demographics. Real estate fundamentals remain healthy for the most part, as illustrated by these charts. Supply and demand illustrates that demand is outpacing supply in every sector except industrial. Labor shortages and disciplined construction lending are keeping a lid on development. A disproportionate amount of industrial supply, however, has been in a handful of markets, including Atlanta, Chicago, Dallas, and the Inland Empire. Absorption trends illustrates demand has been above historical averages in all sectors except retail, and even there, demand is growing despite negative headlines about store closures. Demand slipped slightly in 2019 relative to 2018 for apartment and industrial, but was still strong. Year-over-year vacancy change shows that vacancies continue to fall from near record lows, except for industrial, where vacancies are already extremely low. Rent increases illustrates that with vacancies low and falling further, building owners have a lot of pricing power. Rents are increasing 3 to 4% annually, twice the rate of inflation. The data on retail is a little better than investors might expect given the negative sentiment around the sector, but it should be noted that the rental increases are better for neighborhood and community centers, primarily grocery-anchored strip centers, versus malls, especially lower quality ones, which are faring worse. The spread between core real estate cap rates for major property sectors and the 10-year Treasury yield continues to widen as a result of lower U.S. interest rates. Thus, even if interest rates were to rise, real estate will continue to offer a more attractive yield than Treasuries. What is likely to drive real estate going forward is the less understood subsectors that are driving demand, such as data centers, fitness, gaming, life sciences, sustainable energy, and even cold storage. These sectors are likely to perform better in a slow growth market environment, and even in a downturn, largely as a result of their secular demand. Additionally, specialized sectors that require operational expertise are growing and provide diversified income streams compared to traditional property sectors. For example, illustrated in this chart, powerful demographic drivers are boosting demand for life sciences and healthcare generally, given the aging population and drive to cure diseases. Compared to traditional office buildings, life sciences and lab offices are difficult to operate and require close relationships between property management and tenants. From an investment standpoint, the life science sector is a high growth real estate sector with above market NOI growth that outpaces traditional office buildings. Retail, based on the NPI, remains the worst performing property sector with an abysmal 0.22% total return, comprised of 1.18% income and a negative 0.96% appreciation in the third quarter of 2019. This table illustrates that all retail within the NFI Odyssey has peaked since the beginning of 2018 and has trended down since. Odyssey funds have been taking write-downs across the retail sector for several quarters now. Outside of the mall space, most of these write-downs have been property-specific and/or tenant-specific. This table details the appreciation performance to illustrate the impact of write-downs without offsetting income of retail based on the NFI Odyssey data, which includes all retail properties in the Odyssey funds. In 2020, we anticipate further downward pressure on regional, super-regional mall valuations, power centers, and lifestyle centers, driven by tenant credit considerations, increased capital requirements, and negative investor sentiment towards those brick-and-mortar retail formats. Neighborhood and community centers were the top performing subsector within retail over the last 1 year period through 3Q, and the trend is likely to continue this year as well. In general, those properties are supported by necessity-based consumption and/or discount department stores with considerable consumer appeal and limited e-commerce interaction. Critically, they are often bordered by service-oriented businesses with models more limited to the impacts of e-commerce, or that partner well with e-commerce. Think fast casual dining with the ability to order ahead and pick up in store. The retail sector will likely continue to be quite nuanced, and investors will be selective. Real estate investments have undoubtedly been accretive to client portfolios over the last decade, with annualized returns of almost 9%, but with limited future cap rate compression mixed with anticipated slowing global growth, trade war uncertainty, political polarization, heightened asset values, and disruptive technology, future returns are unlikely to duplicate the last 10 years. However, it is not all doom and gloom for the asset class. Looking forward, potential tailwinds that will likely drive real estate performance include an ongoing low interest rate environment, stable fundamentals, and favorable demographics. Moving on to infrastructure. Economic uncertainty and continued monetary policy accommodation imply that interest rates will remain low for longer than initially expected, which has triggered many investors to de-risk their portfolio, if only marginally, in response to a weaker global outlook. In this lower for longer interest rate world, investors have started to consider investments in infrastructure, which tend to be more attractive in this environment as they provide diversification, solid expected returns, less volatility, and lower correlation to traditional asset classes. Infrastructure investments have continued to garner significant interest from institutional investors, specifically over the past several years as dry powder and aggregate capital raised have continued to increase. In 2019, the market saw dry powder reach $212 billion, 88 fund closings, and $98 billion of capital raised. As depicted in this chart, the return for global infrastructure based on the MSCI Global Infrastructure Index remains robust, as returns from income are expected to remain high in the coming years, supporting a high single-digit expected total return. In addition to an attractive total return premium, the asset class continues to provide investors with a high cash yield. As a large proportion of infrastructure assets receive their revenues from contracts or serve as a regulated market, their income or the distributions are relatively stable. Greater investor interest has driven the inherent discount rate lower for infrastructure. However, this decline is lower than the drop in global government bond yields, so the risk premium has actually risen, as illustrated in this chart. Longer term, as discount rates for private infrastructure have declined in conjunction with global yields, the equity risk premium in private infrastructure has remained stable, averaging 7.2% since the year 2000. As the shift from traditional energy sources to renewables becomes more prominent, we are seeing an increase in private equity energy firms raising infrastructure-like vehicles to invest in renewables, particularly wind, solar, and even battery storage. Solar is typically used as an energy source for the daytime, whereas wind is used at night. But for both to become the dominant sources of energy over fossil fuels, advances in battery storage is critical. Currently, battery storage for renewables is limited to the short term. The reason for this is because lithium-ion batteries have been prone to overheating and catching fire, and are only good for storing energy for short periods of time. The good news is that many companies are investing time and money into more efficient and longer-lasting forms of battery storage. Advances in U.S. large-scale battery storage look set to provide a major boost to the U.S. renewables industry, offering a significant new opportunity for investors. While the industry is in its infancy globally, the U.S. is an early leader as a result of various technologies backed by falling battery and storage prices. Battery storage deals may also offer compelling returns, especially for early investors in this space. Although the heightened levels of dry powder and capital raised can be somewhat concerning, the demand for infrastructure assets is expected to remain robust as investors seek favorable risk-adjusted returns in an uncertain economic environment. With global accommodative policies seemingly coming to an end, investors may be wondering how infrastructure investments will react in a contractionary market environment. The historically high levels of dry powder, new entrants into the market, and contractionary market environment generally present significant risk for infrastructure investments. However, it's not all doom and gloom for the asset class. Infrastructure assets vary by revenue type and contract, each of which has varying degrees of sensitivity to rising interest rates and inflation. We expect investment managers will take advantage of opportunities in sectors and regions in need of upgrades and revitalization in spite of a slowing growth and geopolitical risks. The disruption by key secular trends should continue to alter the future of infrastructure space and open an array of potentially attractive investment opportunities in the new niche sectors.
I'm Derek Schmidt, Marquette's Director of Private Equity, and I'll be reviewing our 2020 outlook for the private equity industry. Private equity returns continued to meet investor expectations through the first half of 2019, with U.S. private equity funds up 10.6% year-to-date and international private equity funds up 9.7% year-to-date. U.S. venture capital funds were up 13.8% year-to-date as the strongest performing area of the market, led by significant IPOs and elevated valuations as investors continued to seek out growth investments. Relative performance, however, was challenged due to the timing of public market volatility, as a market pullback in the fourth quarter of 2018 contributed to private equity's significant outperformance, and a subsequent public market snapback in the first quarter of 2019 presented a tough year in 2019 for relative performance. However, looking at the last 12 months from June, which accounts for both volatile public market periods, U.S. private equity funds have outperformed the Russell 3000 by 480 basis points. Private equity has proven to be an essential component of the U.S. economy, as it provides liquidity within private markets to entrepreneurs, as well as capital and expertise to businesses that strive to grow faster and become more efficient. While private equity continues to mature as an asset class, an increasing number of investors and managers have been attracted to the space due to the growing number of private market opportunities. In 2020, we believe demand for private equity is likely to remain robust, but fall below peak levels raised in 2019. Both the U.S. and global collective managers raised a record amount of capital in 2019, with U.S. managers collecting $373 billion and the global private equity industry collecting $688 billion from LPs. Private equity managers have responded to strong investor demand by raising larger and larger funds, with the average top 5 fund raised the last 3 years being $15 billion versus the previous 3 years where the average was $9 billion. With all this capital raised, it is likely we see a fundraising slowdown in 2020, as many of these mega funds will need to deploy capital before coming back to market. Furthermore, a growing trend in the industry remains for investors to deploy capital either directly or through co-investments in an effort to lower the overall private market program fees. These investments are mostly unaccounted for in fundraising numbers, but will surely increase in 2020, making fundraising numbers less reflective of the overall investor demand. Dry powder remains near record levels and is likely to remain elevated in 2020. The challenge for the industry hasn't been raising capital, but instead putting it to work. Record fundraising and cautious deployment have combined to push industry dry powder to record levels. Preliminary global private equity dry powder reached $1.43 trillion in 2019. This level of dry powder presents a mounting risk for the industry, which requires monitoring. However, looking deeper, we can see much of it has been raised by larger funds and/or focused on expanding areas of the private market, such as mega buyouts, take privates, international, growth equity, and late-stage venture. However, private equity managers face many challenges deploying capital in 2019, with numerous uncertainties around geopolitical tensions, a U.S.-China trade war, Brexit, and regulatory challenges provided by the tax cuts, which limits interest expense deductions, carried interest treatment, and business income deductions. Many of these challenges remain in place in 2020, and investors must remain cautious with increasing global tensions and an upcoming U.S. presidential election. Private equity valuations are likely to remain elevated in 2020. Private equity managers cannot afford to overpay for assets, nor can they afford to sit on committed capital due to their fee structures, as both of these bring down investor returns. This makes the current market fundamentals challenging for investors. However, the significant level of dry powder and elevated public equity valuations are likely both to support elevated private equity valuations in 2020. The growing disconnect between the public and private market valuations remains large, reflecting a 27% discount in private market transactions relative to public market valuations. We continue to believe the most attractive area of the private equity market is with small funds focused on taking advantage of the persistent inefficiency at the small company level. While it's possible venture capital exits may increase in 2020, it is likely we see less liquidity for venture capital investors. While the venture investors experienced fewer exits in 2019, the mega exits of long-awaited IPOs from Uber and Lyft generated a record level of liquidity for venture investors, exceeding $120 billion for the first time. Despite some of the larger names underperforming as public companies, IPOs overall performed fairly well, with an average first-day increase of 17% and an average increase throughout the remainder of the year of 25%. While 2020 is unlikely to produce the same level of liquidity as 2019, a number of exits, including Airbnb, Robinhood, Postmates, Casper, DoorDash, Instacart, and Poshmark, are possible in 2020, as valuations have come down and provide a more reasonable price for IPOs or strategic acquisitions ahead of a presidential election and before the next market recession. The lessons learned within the venture capital industry in 2019 will help to expand markets and improve future investments in 2020 and beyond. As the late-stage venture market emerged over the past few years, managers found themselves anxious to get into desirable companies, with the belief that they were likely to IPO or see their valuation increase with the next round of fundraising. Given this, managers were willing to look past many potential concerns with business models, corporate governance, and questionable founder behavior. Investor skepticism increased considerably during the second half of 2019, led by public market struggles of both Uber and Lyft, along with WeWork's failure to IPO. In fact, WeWork became the poster child for late-stage venture struggles, as the company's valuation fell from $47 billion to $8 billion. Investor demand for these late-stage opportunities is likely to continue in 2020. But investors are already asking a lot more questions and being more critical of these investment decisions. While 2020 may produce a weaker year for venture capital returns, given less large-scale exits and unrealistic valuations that persisted in 2019, the market should become more reliable for investors, allowing for continued expansion of the market as venture managers continue to learn to manage companies at scale. We believe investors' demand for private equity in 2020 will continue, but fundraising is likely to fall as large funds recently raised need to deploy capital. Dry powder is likely to remain near peak levels as managers remain disciplined, with many of 2019's challenges persisting into 2020, along with the inclusion of a presidential election. Private equity valuations are expected to remain elevated as they are supported by dry powder and higher public equity valuations. Venture capital exits in 2020 may increase, but will produce less liquidity than the record levels investors experienced in 2019. And finally, the lessons learned from 2019 within the venture capital industry will likely strengthen future investments and help the industry to grow into the future. We continue to like private equity as a growing asset class for institutional investors who can handle portfolio illiquidity.
This marks the conclusion of our prepared remarks and material for this session. We hope it has been a good use of your time and helped you develop some expectations on what to watch out of the capital markets over the next 12 months. However, if you do have questions, there are a number of ways for you to reach us to have those questions answered. Please feel free to reach out to your consultant or any of the research analysts who spoke on this video. You can also send us an email. There are 2 different email addresses listed on the page here. Please feel free to use either one of those to have your questions answered. Please share any feedback you have about this session. We strive to make these as perfect as possible for our listeners, so if there are changes or additions you would like to see, please share those ideas with us. You can subscribe to our channel for quarterly market insights videos like these. If you would like, you can also register for research email alerts on our website. Any research that is developed and released on our website will automatically be sent to you via email. Last and certainly not least, we'd like to thank you for spending some time with us today. We hope this video has been a good use of your time.